Good morning, ladies and gentlemen. Well, although stocks did bounce last week, I believe that the model really is not going to show us anything interesting or actionable for quite some time. Simply because I believe that this monetary accommodation, which is not being provided by the Fed and is unlikely to be provided for several months, is going to cause a period of chop in everything, bonds and equities. And really, I don't think that equities, apart from certain sectors, can really perform strongly over the rest of the year or even a start of next year without monetary accommodation. And whether that comes or not will all depend on the data over the next few weeks. And I think the data in the US continues strong, and I see no real reason for the Fed to do monetary accommodation now. In the new year, it might be different, but now I doubt very much indeed whether the bond market will allow the stock market to run away into year-end into a normal Santa rally, and I will explain why with the bond section. The short end, the twos, was weak all week, as they say, and I have absolutely no doubt with the auctions coming up on Monday, Tuesday and Wednesday, and we really only have 3.5 sessions next week because of the Thanksgiving holiday, that we will trade 442 and possibly even break it and go up towards 450, 455. I definitely do want to average in long here, from 442 to 450. That's only 4 ticks really in the 2-year note. So from 14 down to 10, because I do believe that accommodation will come at the beginning of next year, just not yet. And that will provide the opportunity to get in. Now, the rest of the yield curve did okay. The 5s really went nowhere. The 10s actually went down a couple of basis points on the week. And the 30s also really went down a couple of basis points on the week, which tallied exactly with what I told you, is that this yield curve now is in a period of correction. While the yield curve in Germany and EU in general is still steepening, but I think that even that is coming to an end. You are getting a period of, this is not really flattening, but it's a period of the steepeners people getting out of the steepeners. Where can it go to? I think it breaks this level and it probably goes to somewhere around here, between 0 and 5 and 7. I really can't see it staying up there for very long at all next year. But I think that we stop everyone out of the steepeners. We're well out of them. Where did we get out? Here. And we will wait for better opportunities to put them on. Somewhere around the 200-day moving average would be ideal, but I don't think that we see that. I think 5 to 10 is going to be about as good as it gets in 2s10s. And if you look at 5s30s, actually, that is beginning to stop. That told you that the steepening was over, and now it's basically, churning around in this area, and we are waiting for the move back down. Funnily enough, 5s30s are almost unchanged on the year, which doesn't really make much sense. If the Fed is easing, 5s30s should be a little bit steeper, but there you go. I guess here we anticipated and here we're lagging. So I think the next move from somewhere around here in 5s30s, what's that, 18, 19, 20 basis points, we start steepening again. But I think that's going to take until the end of the year, or certainly well into December. For the time being, it's flattening, and absolutely no reason to expect that the yield curve will start steepening again anytime soon. What has been steepening and what has been moving is the yield curve in the EU. This is the Schatz. I think we're very close to being done for the Schatz because the short end is already anticipating a move over 25 basis points from the ECB at the December meeting. And I think that that is likely to be enough. So if anything, I would expect that to go back up at some stage, quick move down early next week and then back up, which tells me that the steepening is over even in Germany. So if we look at something like 2's 10s, and that's it, we are basically done, I feel. Might go another few basis points, but that's about it. So if the steepening is done in Germany as well, there is likely to be a little bit of flattening in the US, and that is about it. The more flattening could actually come from Germany now. We could go back to -12, but that isn't a big deal. What is important is that the differentials are moving out. So if we look at the Bund, it's stable. It's not really trending, and I really wouldn't expect the Bund to make new lows. I think it's likely to remain in this range between, say, 218 and 230 and await the ECB meeting there. But what is worrying is the relationship between the Bund and, say, the French market. If we look at the French market by itself, it's beginning to show signs of stress. While the related markets are actually going down, the French market can't go down in yield. And it keeps on bouncing around the 200-day moving average, and that is pretty worrying that it's not following the others. So let's have a look at the spread relationship there. So this is France against Germany, and it's been supported all the time by, I guess, the ECB, but also by the differentials. But is 80 basis points worth the risk? This is as far as or as low as we have been for many years, and here we have the Draghi, whatever it takes. This is beginning to look very, very worrying. The best you can hope for is an extra, if you were long of French market and short of Germany, what could you hope for? 20 basis points that you can make, and how much can you lose? This, you can lose all the way down to, 130, which is another 50, 60, 70, 80 basis points in a panic. This is beginning to look very ominous for another, crisis within the Eurozone. I would be very worried if I owned French bonds, and I would be getting the hell out of them because the extra carry that you are getting is just not worth the risk. Pennies in front of steamrollers kind of thing, and I would be getting the hell out of it. Which then tells me that if you are looking for the potential of some sort of Eurozone risk, why would you be long of Italian bonds? Italian bonds are not showing you on a spread basis any kind of a imminent risk. But on the other hand, they are only, 20 basis points from as low as they have just about ever been. Is it worth holding them? I think risk-reward says probably not. And if there's going to be a crisis in France, or potential, there's also going to be one, the spillover will come into Italian bonds as well. So I'm beginning to think that there is a risk out there that people are undervaluing in terms of magnitude, and really here for an extra 20, 30 basis points that you can make, I'd be getting the hell out of, but certainly out of France, but potentially out of Italy as well. It just doesn't seem worthwhile. And if there is some kind of a euro risk there, then it's going to be shown in the currency. I don't see it at the moment, but I think that that is a big risk that people who are holding French bonds and Italian bonds have to be aware of and try to mitigate it. The differentials between Germany and the US are still going out. This is a longer term chart, as you can see, of twos, and I think 254 is definitely going to be a top. But I even think these levels are not bad to get out of. I'm out of nearly everything I own. For these extra 5 basis points, whatever it is it really worth the risk? Now, I do expect the 2-year note in the US to go up another 5-7 basis points, and I think that that is a great level to get in. Just as I think that the Schatz is probably getting overdone, because I don't think the ECB is going to do more than 25 basis points in December, and therefore the market is already overpriced. That tells me that whether it's at 235 or 242 or even 250, it really doesn't matter, because there will be a bigger pullback. The 2-year note in the US will come down 15-20 basis points from the highs once it reaches them, and the Schatz will also pull back after the ECB or into the ECB. So I fully expect that these levels are pretty good levels to get out, because you are likely to see this 220 or even 215 level again, which tells me that it's unlikely that the dollar really screams here. I would have thought that it's in a trading range and that you buy dips in the dollar rather than chasing the current trend, which is very strong. But it just doesn't seem to me that it's imminent that we get a much higher value of the Dixie and a much lower Euro USD right now, simply because everything is pricing it in already. I would have thought the dip back down here is where you want to buy the Euro USD. This is tens US Germany, and we are getting to a level which is very, very important and through which we haven't been for 4 years. This is the 220. I really don't think we go through it at the first attempt. I think it's far more likely that we come back towards 210 and 202. This would be such a shock if we went through, at least to me. I really don't see the reason, because I don't think it's going to be the 10-year note that goes up in yield, and I just can't see the Bund going down in yield enough to make us bust through this 220. So mark down this 220 level. It's going to be extremely important and significant for all assets, I believe, and especially for the way the Euro USD and the Dixie behave. And, you know, the dollar is a wrecking ball. If the dollar now starts appreciating because we bust through that 220 level, it's going to go a long, long way. I mean, and that is the problem. Look what happens when we go through 220. When we go through 220, we're going to 260. It's a big move, right? It's something very, very significant. So I don't see the reason why it would happen now, and that is also why I tell you, get out of steepeners in Germany. They no longer make any sense. Be careful about owning France. Be careful about owning Italy. And really if we see 220, I would take a big shot at long US, short Germany. The other reason that I can't see US Germany going through that level is because we have pretty damn high. We will be 210 in real. That would mean that we are going through 225, and I think that is terribly, terribly unlikely to happen. So I see real rates remaining between 215, 220 and down here to 2. That is where I see the real rates remaining for the rest of the year. We have Bessant now as the Treasury Secretary. Why would the market make the first move going, taking real rates through the previous highs? I think that is terribly unlikely at the moment. And term premia are at the highs. This is as high as we've seen them already for the year, and therefore I think it's terribly unlikely that the 10-year note now starts a run up in yield, which is the only real way that US Germany can bust that level. I think that we are at pretty high levels. We are fairly neutral. We know that probably the Fed isn't going to do anything in December, but that supports the long end rather than makes it go up in yield. So I really don't see a reason for US Germany to go through that level. And if it does, I think, if it gets there rather, I think it's a very good opportunity to put on a pretty large position saying that it comes back. Well, in Euro USD, I think the world and his mother were stopped out here at 103.58. That would have been the natural level to put any stops, or here, and therefore the stops get executed. This chart does look awful, but I think it's vastly oversold at the moment, and I think that the next move is actually higher, because I just don't see that the differentials are going to continue to support a stronger dollar and a weaker euro. So much is already discounted in the yield curve in Germany, and so much is already discounted for a bigger rate cut by the ECB than we're actually going to get, that I think that the shorts here are really going to get stopped out around the 105, 105.30 area, and that will be the opportunity to put on shorts again. I don't, am I being a pig? Possibly, but just rates are telling me that it's terribly unlikely that they are going to allow the Euro USD to continue going down right here and right now. If I look at the Dixie, it's the same picture really. We are breaking through, but I think it's far more likely that we come back and stop people out and then go. My eventual target is this 109.07, maybe 109.30, so it's not a million miles away, but I just get the feeling that it's being too easy in Euro USD to be short, and also in the Euro index. We are making new lows on the Euro index, but we could easily bounce a couple of percent, and that is all I'm really looking for, because the euro will remain weak compared to the dollar. It's got every reason to remain weak. But the differentials have overshot, as I showed you earlier. The Schatz is overshooting. The 2s are getting to incredible levels. The 10s are getting to incredible levels. Therefore, to me, the risk-reward here is to wait for the bounce that will come when those differentials come back in, and you get a squeeze in the Dixie, and you get a squeeze also in Euro USD. Where will that squeeze come to? Well, probably this area. Again, 105.40. that's where I would short it, or that's the strike that I think would be worth trading at. If the market is at 105.40, buying puts there makes sense. But here, I just think that we've gone too far too fast, and that the interest rate differentials are actually going to force some people to be stopped out. What is beginning to make fundamental sense to look at now is the euro-Japanese yen. You have an easing that will come and continue from the eurozone, and you have a tightening potential from Japan. And this cross has gone a million miles, hasn't it? It's gone from 120 up to 160 and plus in a few years. Does it make sense that this cross will not go back to these kinds of levels, 140s? To me, that is the way of things. The interest rate differential between the two is now going to be very small. Therefore, the cost of carry is the negative carry on it is not going to be that great. I think people are going to begin to switch. So any kind of a move up towards 163, 164, I would be a buyer of yen and a seller of euro. To me, it makes fundamental sense now. As I said, the cost of carry is going to be, the negative carry is going to be minimal, and also the fundamentals go that way because Japan will tighten, and Europe, although it's oversold right now and back at 164, I think it makes perfect sense to buy yen against the euro. Gold has been the bane of my life this year. What to say? I bought it at an average of 25.68, I believe, and I sold it, at 26.01, 26.03. I really did not expect this squeeze in gold to happen last week because I didn't expect bonds to do anything, and I expected the dollar to be relatively strong, and it was, and still gold went up. It's very difficult to understand why. Obviously, there are central bank buyers out of the Far East which really don't care about A, technicals, B, timing, or anything at all. They just continue buying. It's again above the short-term moving averages. What to say about the market which trades this way? Very, very difficult. Where would I buy it? I guess again here at 26.30, that would make some sense. But I still believe that we are going to have some kind of selling before year end. I don't know why I keep on thinking that. It keeps on not happening. And if this is all we get, then we are in for new highs, aren't we? Because this could be interpreted as an ABC, all buyers down here and up we go, and we don't look back at all. I just don't see why that would happen because tip yields are very high, and I would really prefer to buy tips, especially now that Bessant is secretary and there should be some credibility to US policies. We will see what he delivers, but it just seems to make so much more sense to me to buy tip with a real yield, as I showed you, around the 205, rather than gold with no real yield, especially when the dollar is doing very well indeed, thank you. But it's not happening. So when something doesn't make any sense to me, I just stay out of the way and see how it develops. What to say about commodities? Well, not a lot. Where are we compared to the beginning of the year? Well, here we are. We are within 2%, 3% of where we started the year. It's really going nowhere. I refuse to even think about this. The weekly moving average is all coming in. It's just a dead market. And therefore, if it's got no trend, why even play it? It's another sort of brick in that wall of bonds not needing to make new highs in terms of real yield, because there's just no pressure from commodities to to get inflation higher, get PPI higher that would later reflect into CPI. We all know that this week's PCE number will be strong, i.e. 0.3. That's a known, and the market has known it for some time. So I don't see that is going to push yields higher in the US. And with DBC doing what it's doing, I really don't see that there is any pressure for real yields to go up. And therefore I'm triangulating my view of bonds through DBC as well. You know my view on equities. I think it's very, very hard for the indices to make much progress simply because the dollar is being quite strong. Whether it comes back a little, like I think, and then goes again is really immaterial. The dollar is strong and will remain strong. So whether it trades down 1% in the meantime is not the important factor. What is important is that it's strong and it remains strong and probably goes another couple of percentage points stronger on the Dixie with time. Therefore, if you earn 50% of your earnings abroad, like the S&P does, it's very, very difficult for that part of for that index rather, to have a strong trend. And that's why I would like to really concentrate on things like the financials and the small caps, which absolutely do not have that problem. Financials don't care about the dollar. They can even make money out of a strong dollar. So here we have a daily chart of the financials, and they're the ones that after the Trump victory absolutely did not come back. And every time there is any kind of strength, they are the leaders. So if we look at XLF over SPY, we broke quite important levels and we are going up. Where can we go up to? And let's enlarge this. I think that over the course of a month or two, we can go all the way up here around the 90, and we are now at 83, so that's 5-6%, let's call it 4-5% between friends in terms of differential. That is significant. If we have a look at IWM over SPY, I think we can go and test somewhere close to the highs of the year. That's another, what is it? 6, 7, 8%. So those are the sectors that make sense to me, because IWM doesn't have any dollar exposure as such. Every other part of the index has the dollar exposure, and especially something like NQ. And let's have a look at XLK. And as you can see, XLK has really done nothing since the Trump election. It's gone sideways, and really it's gone sideways all the way since July. And that makes sense to me. There's absolutely no reason for XLK to start appreciating strongly at the moment. Rates aren't going to come down, and the dollar's not really going to come down. So whether it trades 240, comes back to 228, then goes up to 244, comes back down to 224, is not really the point. The point is that technology is not going to lead. And therefore, if technology doesn't lead, being over 30% of the SPX, how is SPX going to go up percentages and percentages? Whether it makes a new high next week and then comes back is really immaterial. What I'm saying is that SPX will not be the leader. The leaders should be things, if everything is going up, the leaders are going to be the sectors which have the least dollar exposure, something like XLF, and of course the small caps, which by definition have absolutely no exposure, or tiny exposure. So this is the level that's really, really important on a daily basis. This is the highest close that we've had, around 242. We start busting through there, and let's change this to a weekly chart. If we reset the price scale, is that we have basically a 3-year, almost to the date, range that we will be busting through, and this is an almost, 20 odd percent, 25%. So we're looking for 25% on top of here. So we're looking for relatively large moves from the small caps, from the financials, and it makes sense because the financials are actually overweight in the small caps. So you're getting these movements from the sectors which are least affected by the strong dollar. That makes sense to me. As far as the SPX is concerned, well, last week we did try to break down several times, but we failed simply because bonds would not cooperate. This now becomes the really important level, 58.65. I don't think that we retry it. I think we try the highs just to stop people out, but I don't think it goes very far, because I don't think XLF and IWM and those sectors that are not dollar dependent can really push that far. If the dollar comes back slightly like I expect, that will be enough to get us towards the highs, but the dollar will come back, and therefore I think that the upside is very limited. Where do we have the weekly Bollinger Bands? We have them around here, 60.75, and I think that that is probably as far up as we can go. And what I've said for SPX goes in spades for NQ. We tried to break down, we couldn't, the bonds did not cooperate. We take out the highs around these 21,200, we come back. That to me seems to be the story. I don't think that this sector can lead while the dollar remains as strong as it does, and I see no reason for a fundamental turnaround in the dollar. Yes, we can get the couple of percentage points squeeze that I talked about in the euro because of the differentials and them coming back, but I really can't see this sector leading for quite some time. In summary, I think the steepening in the euro curve is probably done, and I think that the curve in the US flattens a little bit more. I think the opportunity will be in the 2-year note between 442 and 454. I think as a longer term position, it makes perfect sense to average between those levels. The lack of monetary accommodation is going to be temporary, simply because I look at where real yields are, and I think that that is probably high enough, and that the Fed will have enough reason to start cutting again in the early part of next year. So I don't think the 2-year note can sustain certainly 454, because after that it starts having positive carry, and I think people will really buy it. So for the time being, a little bit more flattening in the curve in the US. The steepening is over in the EU, and really the danger is in the Bund OAT, because it really could make a bigger move. It looks awful on the charts. It's below the 200-day moving average. It could really do something, and I have no idea about French politics. Is that going to be the reason for it? Who the hell knows? But it just seems to me that 80 basis points of pickup is pennies in front of a steamroller kind of risk, and I would definitely get out of there because it looks very bad indeed. In equities, you should concentrate on things which are not so dollar dependent, because regardless whether the dollar comes back 1 or 2 percentage points like I think it should, the longer term trend is still higher, and there is nothing to stop it for the time being that I can see on the horizon. Thank you very much indeed, and tweet to you tomorrow.